From New York City for our audience worldwide, I'm Jonathan Ferro. Bloomberg Real Yield starts right now. Coming up, investors looking to shake off DC drama and focus on the policy. On the trade front, where the White House is weighing limits on US portfolio flows into China, and with credit delivering a monster month of debt supply, cracks appear in the primary market. We begin with the big issue, focusing on the fundamentals and not the politics.
The market isn't sitting here waiting for anything out of Washington.
The impeachment process we'll have to live with for months in a very divisive election. I would not be focused on that in all of our investing activity.
You can't trade this stuff right now. It's impossible.
Fundamentally, I don't really think it alters a whole lot around policy or necessarily broader economics.
There's so many different scenarios. You almost have to just almost ignore it and keep just investing the way you would.
We're focused on the Fed. We're focused on the underlying fundamentals.
Right now, to me, trade is still the big thing, right?
We really are focused on trade.
The war with China in terms of the tariff.
The trade deal with China, the negative interest rates that are affecting the markets.
What the market is focusing on still is they would like to see some form of resolution on trade, and that's going to be important.
Joining me around the table here in New York City is George Rusnak of Wells Fargo and Michael Collins of PG and Fixed Income Plus. Luke Hickmore of Aberdeen Standard Investments joins us from Edinburgh. Luke, I want to begin with you. It's something I've heard all week through the week. I want to focus on the policy and not the politics, but it hasn't stopped anybody trying to work out what the politics means for policy. How have you been thinking about that this week, Luke?
Yeah, I guess I have. The thing that worries me a little bit is our experience over politics over here in the UK is the messier they get, the more risk it puts out in the general economy. And when the US arguably over the next 18 months, 2 years, could be facing a recession, it increases the risk of that happening. So it just doesn't feel like something you can walk away from and entirely ignore. It feels like it's going to be part of our lives for a while here, and it just increases those economic risks.
Mike Collins, it's something really, really difficult to ignore. It's going to be a part of our life, but it's really, really complex to handicap. How on earth do you do that?
So we're trained as fundamental research analysts analyzing bonds and companies. So political analysis, especially with people like Trump, is really difficult, right? So our base case is that you don't get a recession, right? I mean, the U.S. certainly doesn't feel like we're in the speculative bubble type of environment. So, you get lower growth, lower rates, moderate inflation, and we actually look forward to more volatility in the markets. We hope that this political noise actually creates some pockets of volatility and opportunities to be more tactical and active.
What's your take, George?
Certainly could use a little more volatility in the markets. It's an opportunity. From our perspective, it's one of two things. It's either a distraction or it's a catalyst, right? A catalyst to sort of getting some trade deals done with U.S. and China potentially. That seems a little bit far-fetched. We think it's a little bit more of a distraction right now. I think what things is being lost in this is a little bit of the USMC. Could it be a distraction to that? Because if that gets through the USMCA, that could add 0.5% to GDP. And when you're coming off a year when you have, the pro-cyclical features coming off, 0.5% to GDP could be pretty significant.
Some of these big issues are incredibly volatile from one day to another. I caught up with PIMCO's Joachim Fowles and tried to get the baseline from PIMCO on what they were looking for in 2020. Looking for 1% growth in the early next year. Take a listen to what Joachim had to say.
We see U.S. growth slowing to something like only 1% in the first half of next year as the slowdown in manufacturing, actually the global trade recession, is starting to spill over into the U.S. service sector and the U.S. consumer. During a period of low growth, during a period of stall speed, obviously the economy is very vulnerable to any adverse shocks.
Luke Hickmore, are we ready for 1% GDP growth in America going into 2020? Is that your baseline?
It's certainly mine. I think our economists are a little bit above that, but I think the risks of that getting there are very, very high. I mean, we've talked, Jonathan, over the last year or so numerous times about how the 2s, 10s curve is such a good predictor of slowdowns and recessions. We can't ignore that. We can't ignore the consumers probably at the best they're going to be at the moment. Employment's at the best it's going to be at the moment. We can't ignore that. And actually, our US colleagues have been moving moving underweight US investment grade credit for the first time in decades. So yeah, it's going to be a problem. We are going to see slower growth, and we're starting to react to it right now.
Mike Collins, what are your thoughts on the matter?
Yeah, I mean, growth is slowing, right? So it was 3% last year. It's going to be maybe 2.5% this year. We think it's actually going to be maybe the high ones next year, but it's on a slowing trajectory. And I think people who say, is there going to be a recession or not, are missing the point, right? It's not necessarily a binary outcome. Slow growth is bad for highly levered credits, right? And we've had obviously a big relevering in corporate America, globally in credits, and 1% growth is going to be a really challenging environment for a lot of companies.
What do you think, George?
Yeah, 1% is a little bit lower than our base case. Our base case is high ones, 1.7, 1.8. So yes, the trend line is disturbing, right, and concerning. And certainly the bond market is telling you from that inverted yield curve that there's potentially challenges ahead. Not a baseline of a recession, but certainly a slowdown is what we're seeing.
We're always focused on the shark closest to the boat. The shark closest to the boat this week has just been incredibly volatile politics down in Washington, D.C. It's interesting that what has hardly been spoken about is terrible PMIs in Europe. We looked at them for 5 minutes, we moved on. A German business confidence number that was ugly. South Korean exports, consumer confidence in America, consumer spending in America slightly disappointing as well. You put that all together, Mike Collins, is there still enough appetite out there for duration at these kind of yield levels with the fundamentals that underpin that too?
Absolutely, right? I mean, the slowing growth is the fuel for potentially lower yields. I mean, we actually look at the other side of the data, and there's been some actually pretty resilient results in the U.S., especially in the consumer and services sector. Right? The U.S. just feels like we're going to kind of hum along at 2 or maybe a little bit below 2, but it's really hard to see a sharp slowdown, like a consumer or even business-led slowdown in the U.S., right? So I think we can actually bolster the rest of the world. But if that doesn't transpire, and if you can continue to see weakness abroad, yeah, the 10-year Treasury at 170 has a lot of scope to fall from here.
Luke, what are your thoughts on that matter? How big the demand for duration will be and how insensitive it will be to how low yields are already here in the United States?
It feels, I agree, it feels we could go lower from here. We probably need the Fed to kick in again, and that might be next year now with the Fed rhetoric seemingly changing recently. And actually, right here, right now, the data's improved a little bit better than people have been expecting. If you look at things like the Citi US Economic Surprise Indices, it's been pumping up a little bit recently. So we might get a bit of a pause for that. We might get August feeling okay, and the numbers around that in September as well feeling okay. But it feels that that's going to be a short-term relief. I think the problems that are building up in the US economy are enough that we will be talking about sub 1% growth pretty regularly next year, and that means duration's a great buy from here.
Final word, George?
I think right now the direction for rates is down, but I don't think it's necessarily down as significant maybe as some of my counterparts, but I do think that sort of a neutral view on duration is probably the way you want to be right now. And so you're going to see things tick down in a kind of gradual manner right now.
Hey guys, you're going to stick with me. We'll talk about credit in the following segment. Coming up on the program, the auction block. A record number of high-grade borrowers coming to the market this month. That conversation is coming up next. From New York, this is Bloomberg Real Yield. Jonathan Ferro, this is Bloomberg Real Yield. I'd like to head to the auction block now and begin over in Europe, where a thirst for yield was still on display, with Italy closing out the week selling 6.75 billion euros of 5 and 10-year bonds, the 10-year portion priced with yields at all-time lows. Wrapping up the month in the US investment grade market, what a month it has been. Bond sales cracking the $150 billion mark this week, marking September as one of the busiest months in new issue history. Over in high yield, a busy month too. Borrowers pricing roughly $29 billion of bonds through September, making it the busiest month of the year so far for JUC issuance as well. Staying on credit, here's Howard Marks of Oaktree weighing in.
I think it's a time to be careful, not to pull back. We're investing every day. We're essentially fully invested other than in our funds, which are explicitly reserve funds. We're trying to get fully invested in the others. But with caution. And as I described earlier, we take a risk-controlled approach to our risk asset classes. When I say with caution, I mean even more cautious than usual.
George Rosenak, Michael Collins, Luke Hickmore, still with me. Let's start with you, Mike Collins. Your thoughts on credit right now. A cautious approach, warranted?
Yeah, I mean, there's been a lot of supply, right? But the net supply has actually been really contained, meaning a lot of the supply we've seen in September is refinancing existing debt, right? So that's a really good thing. So you're seeing a huge increase in Treasury supply, kind of a pullback, believe it or not, in the net supply of private corporate debt. So the technicals continue to be really strong, right? Especially with QE, on the come in Europe, you're seeing credit spreads in Europe continue to tighten. But I agree on the risk side, you have to be really careful. And you're definitely seeing pushback in the credit markets with some of these.
Well, let's talk about that pushback. So one of the busiest months ever for investment grade issuance through September, the busiest month of the year so far for high yield. Where are you seeing the cracks in the primary market? Where's the pushback at the moment?
So it's funny. So in the last couple of years, right, all the lousy, highly levered issuance went into the loan market, right? Because the loan market was seeing flows in from CLOs and bank loan investors. And so the loan market was just, accepting any kind of lousy deal. And then the loan market shut down because all the money's pouring out, right? 30% of the loan market has gone out the door in the last year. So now those issuers are trying to tap the high yield market, and the high yield market is pushing back, right? So historically, the loan market was like the higher quality part, and the high yield market was the riskier part. The high yield market is saying, no, thank you. We want higher coupons. We actually want covenants, and we want lower leverage, right? So these issuers who thought they could access the loan market can't even get into the high yield market.
This sounds somewhat counterintuitive, Mike, but when rates were going up, that's when covenants were disappearing on floating rate debt. And I wonder that if it's because rates are coming back down that actually this dynamic is playing out. Now, that's going to sound wild to so many people watching this program, but is that what's happened in the last couple of years?
Yeah, the loan market is like a topsy-turvy part of the bond market, right? When the front end yields go up, when the Fed's raising rates, people want loans because their coupons float up, right? And when the Fed is cutting rates, people avoid the loans because your coupon is going down, right? So it's the opposite of what you'd normally
Look, Hickmore, just to bring you into
the
the conversation, what do you make of that pushback that we have seen in the primary market? And to take it another step, why haven't we seen that spill over into the secondary market just in terms of where spreads are? We've seen some pushback in the primary market. I'm not seeing materially wider spreads after that. Why not?
I think if you break it down a little bit more into the high yield space in particular, there's signs of stress coming through. So the first half of the month, you had triple C's performing really actually very well. Latter part of the month, that tailed off really quickly.
Spreads have started to widen just a little bit. What's more interesting to me is that the tights of the year, in and around 350 basis points on the Bloomberg Barclays High Yield Index, we're struggling to get back down to them. And every time we come close, we widen up again. What kind of signal does that provide us?
Right now we're underweight on high yield. From our perspective, there's not really great an opportunity there right now. The spreads are so tight. And from our perspective, I mean, if you look at these companies, they've leveraged up, and now you're starting to see the cracks build up. The only thing that gives me a little bit of optimism here, John, is that we're seeing just tremendous appetite from the individual, right? The individuals are just dying for yield anywhere with a lack of appreciation of risk. So I wouldn't doubt if it holds in for a little bit here, but come that after that holds in for a little bit, probably going to back up after
Explore that further for us, Mike. Just struggling to test the tights of 2019.
Yeah, I'm talking about topsy-turvy markets, right? And you're starting to see, I think, the leading indicators of the credit risk, right, appear in the markets. You're seeing it across all of the markets. You've seen it even in equities, right? The IPO pushback and the small caps, cyclicals really underperforming. Yep. And in high yield, you've seen this really weird market where spreads are tighter, high yield's done great, but double Bs have outperformed triple Cs, right? The triple C spreads have really lagged. So what we're doing is actually selling the double Bs. A lot of the demand we're seeing, especially from overseas investors, is in that higher quality double B part, and it's taken the value out of that part of the market. But the single B, triple C market, again, and I don't want to paint it with a broad brush, you have to be really selective, actually looks like it's decent value.
There's a split in both credit and sector, I would say, within the high yield market, where you're seeing the weaker sectors and the weaker credits underperform and the stronger ones outperform, and that's something that you're going to have to play.
I don't suppose the oil move of the last couple of weeks has helped things really. Who would have thought that oil would be back to where it was a couple of weeks just before the Aramco attack, that we'd be back to those kind of levels within a couple of weeks? That's happened very, very quickly, and I imagine that's not happening high yield's cause. Just to tap into IG just for a moment within investment grade, something that you've noticed, Mike, is that the levering up that's being done is being done by the higher rated issuers, and that the triple Bs, the companies behind some of those ratings, are actually doing some of the hard work still. What do you make of that dynamic right now?
Yeah, so in investment grade, right, you're not paid basically to be a AA rated company anymore, right? So the AA's go to single A's, the single A's go to triple B's. That seems to be the sweet spot. But once you're in triple B, you're really reticent to go into junk, because then your liquidity dries up, your financing opportunities dry up. You just can't refinance a $100 billion balance sheet in the junk bond market, right? So these big, highly levered triple Bs have actually found religion to some extent, and they are delevering to some extent. But I'd say on average, though, we're still really cautious in that space, because you don't always have to lever up by increasing debt. Sometimes it's the EBITDA or the earnings or cash flow going down, right? And when you have a flat earnings growth picture, which you do right now, earnings growth is expected to be zero basically this year. That means half the companies are going to make money, half the companies are going to lose money. If you have a lot of debt and your EBITDA is going down, that is a big problem.
So we're going into 2020 and everything's in the balance right now. And if I ask someone what their baseline is, recovery or recession, PIMCO basically turned around to me earlier this week, Joachim Fowles, and just said, look, it's a low conviction view. It's a lower conviction view. I think recovery. With that in mind, you face a fundamental question. I want to be in the market. I want to be prepared for the worst but present for the best. What do I do, Mike Collins? What do you answer back?
I say you own, high quality bonds. I still think fixed income has value, especially in the U.S. I think there's a lot of spread, believe it or not, in high quality bonds. Senior debt of the banks, even subordinated debt of the banks, even the preferred debt of the banks. High quality structured products. These have really big spreads relative to treasuries, and I think those are going to continue to outperform. In the credit side, you have to be really careful, but there's value out there. There are bonds that have pretty attractive expected excess returns.
George? I agree. You have to be really selective here. I think you're not going to take risk. We don't think you should take risk in duration, interest rate risk. You shouldn't take credit risk. But where you should really focus is on the sectors right now. We do like preferreds. We do like corporates, investment grade corporates. We think in that triple B sector, you have to be really selective there. And we actually like even emerging market debt here. But you're going to have to go to different places to get yield in sort of those subsectors.
Guys, you're going to be sticking with me around the table here in New York. Still ahead on this program, the final spread, the week ahead, featuring a big week in economic data with US payrolls, the spotlight. That's all coming up. This is Bloomberg Real Yield. I'm Jonathan Ferro. This is Bloomberg Real Yield. It's time now for the final spread. Coming up over the next week, it begins Sunday night. It begins with PMIs out of China and industrial production from Japan. Tuesday, US ISM manufacturing and construction data. Thursday, more economic results out of the United States, including factory orders. And then on Friday, Chairman Powell will be speaking, plus the main event, a US payrolls report as well. George Rusnak and Michael Collins still with me. But something I wanted to pick up with you, Mike, is just how quickly sentiment has swung from week to week, and the degree to which that price is shaping the narrative. I think many people have noticed over the last couple of weeks that we've started the show one way and then started it the other the next week, and many people have just completely changed what they think about the world on thin air, on very little. And it's because Treasury markets have been really whippy. Yields up 30 basis points, yields down 20 basis points, and nothing much has changed. What explains that, Mike?
Yeah, I mean, part of it is the fact that we seem to be at this inflection point in the economy, in the rate cycle, in the central bank cycle, right? And that creates a lot of uncertainty from day to day as the economic data comes out, right? The Fed is very data dependent here, right? Remember, there's a lot of FOMC members who think we should be raising rates over the next couple of years, right? So it's very data dependent, but I think the Treasury positioning and the general duration positioning has been really volatile. When rates rally, people have been panicking and buying duration, right? And chasing them further down. And then when rates start selling off, people get more optimistic on the economy and they try to sell them. So I think the positioning has been getting whipsawed.
What do you think, George?
Yeah, I think there's a directional trade that's been going on, and a lot of it is due to positioning. I think there had been some sort of short-term effects where people have gotten positioning for rates to go back up, and when they go back down, they have to cover some of those shorts, and that's actually exacerbated some of this. But I think it's just the uncertainty within the marketplace. Nobody knows what to expect from a trade deal perspective, where we're going to go next, and so I don't think you should be positioning for those short-term moves. You have to be positioning for the longer term.
What do you think holds the keys to a more sustainable move higher in Treasury yield? What holds the keys to that? Is it the Fed? Is it the trade story? Is it Europe? What is it?
I think it's more the Fed than a trade story right now. I think the Fed starts backing off, and you saw this, I think, a little bit, very little bit, last week when the Fed talked, right? They gave sort of the dovish action of lower rates, and they kind of gave a little less dovish on the verbiage around that. The first time they did that, the markets reacted very vigorously, and they haven't yet. So if they kind of pull back on that, you could start seeing rates potentially come back.
A lot of people might think it's the trade story. I mean, Bloomberg in the last couple of moments have broken this story about the White House weighing limits on portfolio flows into China. Nobody knows what to do with that. It feels like a very early preliminary conversation, but still, you've got to think about these things. What on earth do you do?
Yeah, so I mean, clearly the trade thing is volatile, and it's going to be, right? We don't think there's any big resolution that's going to come anytime in the next few quarters. So I think people who are expecting that are going to be disappointed. This is just, today's announcement is just another example of the tit-for-tat negotiating process here. But generally speaking, I think if the Fed starts pulling back on its dovishness and says, all right, we're going to do one more hike and we're done, and some of the hawks start to win sway and the data gets better.
Well, Mike, let's be clear here. That feels like where it's going at the moment. We've had Bullard Evans earlier this week talking about perhaps we go into wait-and-see mode.
That's a curve flattener, right? So what that means is the front end, which is still pricing in several more cuts, pushes back up. But I don't think that means the back end of the curve elevates, right? The back end of the curve is going to continue to be weighed down by these big global flows. And I look at our yield sometimes, our 10-year Treasury at 170, and sometimes I wonder why it has a one handle, why it doesn't have a zero handle. When you look at the yields in the rest of the world, sometimes they have to look at it twice, say, oh yeah, it still is in the ones, not in the zeros, right? And it feels like the global flows are going to continue to weigh on the back end of our market and keep a lid on those rates.
Guys, we're going to do the quickest rapid-fire round we've ever done, the most rapid-fire round we've ever done, because Luke Hickmore won't be with us for it, so it's just the two of you. Let me begin with the impeachment inquiry in the United States. So many people were trying to work out what this meant for policy elsewhere. What did it mean for trade? Did the president double down or back off? So does the president harden or soften his stance on China going into trade talks next month? Harden or soften his stance? Mike?
Soften.
George?
Yes, soften.
2020. As PIMCO put it, the window to US recession or recovery. Let's pick one. Recession or recovery in the back half of 2020. Recession or recovery. George?
Recovery.
Mike?
Yeah, recovery.
Let's finish with a question on credit just quickly. Have we seen the tights on high yield spreads for the year? Have we seen them already? Yes or no? Mike?
No.
George?
No.
Guys, great to catch up with you. To George Rusnak, to Michael Collins, thank you very much. And I should also say thank you to Luke Hickmore as well. From New York City, that does it for us. I will see you next Friday at the same time, the same place. This was Bloomberg Real Yield. This is Bloomberg TV.